Subscribe to my channel Report Stock.
Welcome to the Deep Dives. Today we're taking a close look at SCKT Mobile. You might know them for their data capture gear. They just released their second quarter 2025 financials, and, well, it tells quite a story. We're seeing some significant headwinds, revenues down, losses widened a bit year over year. So our mission today is really to unpack what these numbers mean. What challenges are they actually facing? And crucially, how are they planning to navigate this tough market? We're pulling this straight from their Q2 report and the CEO's comments.
That's right. And these financial reports, they're more than just spreadsheets, aren't they? They're kind of like a snapshot, showing company health, but they also give clues about strategy, future plans. We're really going to dig into the story behind these figures today.
Okay, good. So before we dive deep into the actual numbers, maybe let's just set the scene a little. For anyone listening who isn't super familiar, who is SCKT Mobile, what do they actually do?
Right. So SCKT Mobile, their ticker is SCKT on NASDAQ. They're a key player in, data capture and delivery solutions. Think cordless barcode scanners, contactless readers, that kind of thing. But what's really important here is how their revenue works. It's mostly driven by how these devices integrate with other companies' mobile apps, the ones that use barcodes. It's all about enhancing workplace productivity.
Okay, so integration is key. Who are their typical customers then? Or which markets are they really in?
Yeah, the report lays this out pretty clearly. They mention mobile apps serving specialty retail, field service, digital ID, transportation, and manufacturing markets. Those are their primary revenue drivers. So it paints a picture of specific industries relying on their tech.
Got it. That helps frame things. Okay, let's get into it then. The Q2 financials. Diving into the highlights, what's the first thing that really jumps out about their revenue?
Well, the top line revenue came in at $4.04 million for Q2. Now, the interesting part is how that compares. It's actually down 20% from the same quarter last year. Q2 2024 was $5.08 million.
Wow, 20% is quite a drop.
It is. But there's another angle. It's actually up slightly, about 2%, compared to the previous quarter, Q1 2025, which was $4.0 million. So, yeah, a year-over-year dip, but a tiny, tiny sequential rebound.
Okay, a mixed signal there. What about profitability? Did margins hold up? How are operating expenses looking?
Good question. Gross margin for Q2 was 49.9%. That's a little lower than the 50.9% they had a year ago, and also down slightly from 50.4% last quarter. So small compression, but it's there. On the other hand, operating expenses, or OPEX, came in at $2.7 million. Now, that's down from $3.1 million a year ago and also down from $2.9 million last quarter.
Okay, so they're definitely tightening the belt on spending.
Exactly. It shows they're actively managing costs, which, you'd expect given the revenue situation.
So lower revenue, slightly lower margins, but also lower costs. What did that mean for the bottom line? Were they profitable?
Well, despite cutting those costs, they still reported an operating loss. It was $677,000 for the quarter.
And how does that compare?
It's actually a wider loss than the $535,000 loss they had in Q2 last year.
Okay, so worse year over year.
Yes, but it is an improvement compared to the quarter just before this one, Q1 2025. They lost $894,000 then. So still in the red, but the loss did shrink compared to Q1. The rate of loss slowed down a bit.
Right, okay. Let's talk cash. Always important.
Yeah.
How does their cash balance look after all this?
Their cash on hand at the end of June was about $2.6 million. And this is interesting. It's actually up from $1.7 million at the end of March.
Up. How did that happen with an operating loss?
Yeah, it's also slightly higher than the $2.5 million they had at the end of last year. The report specifically points to one key event. They secured $1.5 million through something called a secured subordinated convertible note financing that closed in May.
Ah, okay. That explains the jump. Can you quickly break that down for us? Secured subordinated convertible note financing. What does that really mean for the company? Especially for listeners who follow this space closely.
Sure. So basically, think of it as a loan they took out. Secured means they likely put up some assets as collateral. Subordinated means if things go really badly, like bankruptcy, this loan gets paid back after other, more senior debts. And convertible note means that instead of just paying back the cash, the lender usually has the option to convert that debt into company stock at some point in the future.
I see. So it gets them cash now, but could mean more shares outstanding down the road. Dilution risk?
Exactly. It's a way to raise capital when maybe traditional loans or selling stock isn't ideal. It shores up the balance sheet now, but yeah, potential dilution is something investors would watch. It definitely signals they needed that cash infusion.
Right, okay. So the numbers tell one part of the story. But the CEO, Kevin Mills, provided some context, some color commentary. What did he say were the main reasons behind those weaker revenue trends?
Yeah, Mills was pretty upfront about it. He said they continued to experience weaker revenue trends throughout Q2, driven by a slower run rate. Standard stuff, maybe. But here's where it gets really interesting. He specifically called out concerns around potential tariffs.
Tariffs. How did that impact them?
He said those concerns led to significantly reduced purchases from our distributors.
Yeah.
And that, in turn, caused a notable decline in bookings in Q2, which then, directly hit their actual shipments and revenue.
So it wasn't just general economic slowdown, but a specific tariff issue hitting their distribution channel. Yeah. That really clarifies the why.
Exactly. It points to a very specific external headwind.
And does he see this as like a temporary blip, or is this something they're bracing for long term?
Well, he was quite clear on that, too. He said, we expect these headwinds to persist through the remainder of the year.
Okay. So no quick fix expected there. That certainly raises the stakes for the rest of 2025.
It does. It puts pressure on them to manage what they can control.
So knowing these headwinds are likely sticking around, what specific actions did Mills say they're taking? How are they responding?
Well, two main things he highlighted, which line up with the financials we just discussed. First, that financing deal we talked about, raising the $1.5 million via the convertible note, that directly addresses the need for a cash runway.
Right, bolstering the balance sheet.
And second, he mentioned they implemented cost-saving measures, specifically pointing to reductions in operating expenses, which, again, we saw reflected in that lower $2.7 million OPEX number.
Okay, so the two-pronged approach. Get more cash in the door and spend less going out. Makes sense in this environment.
Pretty standard playbook for navigating a downturn, yeah. Conserve resources.
It sounds like they're definitely playing defense with the financing and the cost cuts.
Yeah.
But amidst all that, was there any, positive news, anything on the innovation or product side, a glimmer of hope?
Yes, actually. And this could be quite important for their future. Mills specifically mentioned their new XtremeScan products. He said they've been well received by initial customers and are starting to gain broader interest.
XtremeScan.
Yeah.
Okay. What's special about those? What are they designed for? Is this a potential growth engine?
He gave some detail, said they're being used in conjunction with iOS devices to enable frontline workers to capture data more precisely, respond more decisively, and execute critical tasks with greater speed and confidence.
Okay. So targeting frontline workers, maybe in tougher environments, needing high performance, paired with Apple devices.
Seems like it. It suggests they're aiming at perhaps a more demanding, maybe higher value niche within the data capture market, focusing on performance where speed and accuracy are absolutely critical. This could be a way to differentiate and maybe find some growth away from the tariff-impacted areas.
Interesting. So a potential pivot towards higher performance applications. What's the next step in terms of them sharing more about this?
Mills wrapped up by saying they look forward to sharing more details about our new product initiatives and strategies during our upcoming conference call. And actually, that call happened today, July 31st. So more details should be emerging right about now for anyone wanting to dig even deeper.
Right. So let's try and tie this all together for you, the listener, trying to understand how companies handle these tough spots. We've clearly seen Socket Mobile facing some serious market challenges.
Yeah.
Those potential tariff concerns hitting distributors. That's a big deal, leading directly to lower bookings and that year-over-year revenue drop.
Yeah, significant headwinds. But at the same time, we see their clear responses, right? Securing that $1.5 million in financing, a strategic move to get cash, and then the cost cutting, being disciplined with spending. But maybe the most fascinating piece, as you said, is this focus on the new XtremeScan line. It's not just tweaking old products. It feels like a potential strategic shift towards maybe higher margin areas to counter the broader weakness.
It really does paint a picture of a company in transition. They're using financial levers, like the note financing and cost control, to buy time, while simultaneously pushing innovation, like XtremeScan, hopefully to drive future growth. So the big question this leaves us with for you to think about is this. How vital is that kind of new product innovation, like XtremeScan, when the company is facing such strong external pressures? Especially when something like global trade concerns, these tariffs, are directly hitting their core business. Is innovation enough?
And maybe tied to that, how long can the cost savings and that financing sustain them? When do those new products need to really start contributing significantly to the top line to turn things around?
Exactly. Lots to watch with Socket Mobile going forward.
Subscribe to my channel Report Stock.